Industries that are hot, sectors set to outperform the market. That's what's here in Zacks Industry Rank Analysis. Charles Rotblood, our senior market analyst at Zacks.com, puts this report all together for us each week. He joins me once again now to elaborate on something, a little different take on the industry rank analysis this week. On the radar, you're looking at the financial sector, but you're looking at it from a little bit of a different vantage point or a little bit of a different perspective here, kind of like an I told you so.
Well, I really don't want to be quite that blunt, but we've talked about the financial sector periodically for several months. Throughout 2008, we've seen more estimates being revised downwards than being revised upwards for the entire sector. As we look right now, as of today, for 2008 earnings, for every one positive revision, there are 5 negative revisions.
And today is September 17th, by the way.
Today is September 17th. So we're seeing this continuing decline, but when we look at some of the news, particularly Tuesday night, as many people watching this know, the Fed stepped up and they bailed out AIG, really threw them a lifeline. Now, keep in mind, this lifeline I talk about on our Tell the Tape blog. It's on I'll link to it. It's on the homepage of Zacks.com. But they basically gave AIG a loan with a lot of limitations on it, a lot of restructuring. Executives were fired, and AIG is basically paying credit card interest rates for this loan. But what I want to do is not talk about what happened on Tuesday night, but I really want to kind of go through some of the numbers and some of the tools that are available on Zacks.com for free and show people, look, here were the warning signs as they actually developed in real time so that people can kind of see, okay, this is what I might have missed, or this is what I should be paying attention to with other companies I've invested in so that the same mistakes aren't made. It's not really I told you so, but it's more of, okay, this happened, what can we learn from it? So let's just start off with talk about AIG. And one of the things I talk about with AIG is the following estimate revisions. Here at Zacks, we constantly talk about earnings estimate revisions, telling people to always look for companies with positive earnings revisions. We also advise people to avoid companies with negative estimate revisions. And the reason why, if you see estimates being cut, it's a sign that the analysts believe there's something going on with the company, there's something wrong. Maybe it's a temporary slowdown in business, maybe it's a bigger problem. And when we look at AIG, it's really interesting because in February 2008, analysts were expecting the company to earn $6 per share this year. As of Tuesday night, right before the Fed threw its lifeline, the consensus estimate called for AIG to lose 81 cents. So in percentage terms, that's massive. You're going from saying, okay, you'll earn $6 per share to losing 81 cents. And throughout the year, we can point out different periods where if anyone had just looked at see what the estimates were, seen where they were 90 days prior, people would have had a warning sign. For instance, we talk about $6 in February. And an investor said, okay, well, I still like AIG. I'm going to hold on to it. And they came back 2 months later and looked at April. Estimates have been cut down to $4.29. So just within a 2-month period, we saw estimates being cut by about 30%. So there was this trend, and people can go onto the earnings estimates page on Zacks.com, look at the trend of estimates for the last 90 days and see that trend. If you're seeing a continuing cutback in earnings, particularly if it's a big cut, it's a warning sign that there's something wrong with the company and you should bail out of it.
All right, so that's one negative hallmark. And is that 90-day window, is that a standard window, or will that vary from situation to situation as far as when those red flags begin to present themselves?
It varies from situation to situation. The company's warns will typically see the estimate revisions being revised downward within 7 days.
Okay.
Typically within a couple days of a warning being announced, we'll usually start seeing some negative revisions. It's really good for people to just check even once a week. But however, if you sign up for a portfolio on Zacks.com, completely free again, you'll get an email that actually tells you what the change in estimates are for the stocks within your portfolio every day. Again, this is a free tool, and it takes 2 seconds for someone to scroll down the email, see if there's been any change. I do it every morning for my own stocks, for the stocks we hold on Zacks Elite in the top 10. Very simple for investors to do, and again, it's completely free.
Okay.
Now let's move on here. Let's talk about Lehman. Lehman, as everybody knows, is about to go bankrupt. Long talks over the weekend. No lifeline from the Fed here. And as we talk, Lehman right now is trending about 19 cents. We have a chart in Zacks.com called the price and consensus chart. And what it does is it shows you what the trend in earnings estimates are for the full year and how the stock prices are reacting to it. In the case of Lehman, really up to the summer of 2007, we saw estimates constantly being revised upwards, and we saw the stock price rising along with it. Then we get to around mid-2007, we start to see estimates being trimmed down, start to see the stock price really start to fall. throughout 2008, as earnings estimates continue to get cut on Lehman, we saw the price fall. This is a really handy chart because it tells you, A, what the historic trend in earnings estimates are, whether estimates have traditionally been revised upwards or downwards, and B, how the stock is reacting to it. Ideal situation, we want to see earnings estimates being revised upwards and the stock price moving in lockstep with those earnings estimates. On the flip side, if you start seeing estimates being cut and start seeing the trend in the estimates being cut and you see the trend in the stock price being cut, that's a really good warning sign for someone to just cut their losses, get out of the stock, and certainly Lehman at any point until the past few weeks, there was numerous opportunities and numerous red flags to get out of the stock. You're always better off taking a small loss and waiting for the stock to sell, waiting for things to play out, than to take a big loss and hope that somehow there's a magic save to this company. In the case of Lehman, unfortunately, there's a lot of people that kept holding onto stocks, hoping a white knight would appear, never appeared, and now you can buy actually a coffee mug from Lehman's actually worth considerably more than the stock of the prices.
Okay.
Another stock we're talking about is Washington Mutual. Washington Mutual, still solvent, still doing very well. In the case of Washington Mutual, it's interesting. I show the history of earnings surprises. We have a chart on there called the earnings surprise chart. And basically what it shows you is whether or not a company has beat or missed earnings. In the case of Washington Mutual, even when times were good, we had the housing bubble going in full swing out in California, the company still missed estimates and missed estimates many times and reported negative earnings surprises. That's a sign that the company is not only not managing expectations correctly, but there's something else going on. In the case of Washington Mutual, if it couldn't meet expectations where times were good, it was definitely a red flag that when times got bad, it certainly wouldn't meet expectations. And that's what we're seeing now with Washington Mutual. The stock's trading, I think, about $3 per share right now. A lot of rumors about the future of this company. Again, if investors just paid a history and taken note of those warning signs, they could have avoided large losses in the stock as well.
All right, this is pretty interesting. So the lessons to be learned here are?
Well, the two lessons is A, when you start seeing negative trends for the entire sector, as we've constantly talked about with the financials, that alone is a warning sign to really be cautious about the industry. But then if you start seeing those negative signs for the sector, and you start seeing also negative signs for your stock themselves, pay attention. You can always sell a stock and buy it back later, and you're always better off moving to the sidelines if there is uncertainty rather than trying to be a hero. The best thing for investors is always to control your losses, and that's one of the best ways you can improve your overall return is if you act quickly to contain your losses. Now, there's going to be times where you're a little slow or something just blows up on you. There's nothing you can avoid, but you're always better off taking the loss you know about now versus risking an even bigger loss in the future.
And you do, on the flip side, come up with a couple of positive plays within the financial sector.
I do. I have two companies I mentioned. They do have rising earning estimates, a history of positive surprises. I do encourage investors, and I say this in the article, to do further research on them because they are in the financial sector and there's still macro trends that could be against them. But I wanted to give investors some hope and show them some companies within the financial sector that do have some positive historic trends that might be worthy of at least taking a closer look at and kicking the tires.
All right. We'll encourage our viewers to check the text version of Charles' analysis this week for those positive plays. I just had one general question that I wanted to kind of wrap up with here, and that is this AIG situation, because it is so much in the news. Immediate impact to the insurance industry, or is that impact not going to be felt for a while going forward?
I don't know if there's going to be an immediate impact to the insurance industry. I think with the property and casualty companies and the reinsurers, the bigger impact is Hurricane Ike, which not only caused massive damage in Houston, but a lot of flooding throughout the country. But I think for some companies, long-term, it could benefit some companies that are able to pick up some of the pieces from AIG. The company's going to be broken up, and a lot of their insurance businesses are actually in pretty good shape. But I think for the Fed, they obviously saw something that was very negative and that scared them. And I think the Fed pretty much approach us from a situation that if we don't do something now, this really could create havoc. So on the surface, it looks like the Fed did the right thing. I think for the insurance sector itself, over the short term, I think this is really a non-event. Over the long term, though, it could definitely help some insurance companies, especially if they're able to get some of the profitable pieces at AIG at fire sale prices and able to actually increase their market share.
Do we know yet if these loans are payable back to the government if these bailouts, are they loans like the Chrysler situation was when they bailed them out? They had to pay it back plus interest?
They are. They are actually payable back to the Federal Reserve. My understanding is the Fed will get 80% of any proceeds from the sale. And the price of this is really LIBOR plus about 8%. LIBOR is a London interbank exchange rate. It's basically the rate that most credit cards and most variable loans are based on. So really, the loan is really what, if someone were to get their MasterCard out and get maybe one of those checks that credit card companies send to us, write a loan, say, oh, I need some cash off my credit card. The interest rate you'd be paying for that is really what AIG is paying the Fed right now. So there is some speculation that this could actually turn out to be a profit for the Federal Reserve. Obviously, there's always a slippery slope when you start saving companies as to what is the next company you save. But I think, the flip side of that is the Fed really set some pretty stringent terms on this loan. The executives at AIG were fired. The company is being broken up. So I think for some executives, particularly automakers, they should take a look at this and think, okay, if you depend on the Fed to bail you out, don't be so sure that you're really going to get a sweetheart deal, because the Fed is definitely playing hardball. And considering it's our money, it's very good if they are.
All right. You mentioned some stocks here. Do you own any of those stocks?
I do not own any of the stocks.
All right. Once again, I will encourage you to take a glance at Charles' text version of this week's industry rank analysis. It's a very well-written piece, and it does point out a lot of important lessons that could have been learned here had you consulted with some of the indicators that we provide for you on Zacks.com. With Charles Rotblatt and the industry rank analysis, I'm Terry Ruffalo.